What if you could go back to January 25 with 10,000 and invested in one of the world's biggest stock markets? You could choose India, the United States, the United Kingdom, Germany, Japan, China, Hong Kong, South Korea, or the wider European market. Now imagine that every investment starts at exactly 100%, and we let them race all the way to August 2026. Which market would have turned out to be the best investment? And which one would have left you wondering, what if I had chosen differently? Today, we're going to find out. At the starting line, every market is equal. The Nifty 50 and Sensex represent India. The S&P 500, Dow Jones, and Nasdaq 100 represent the United States. FTSE 100 takes us to the UK, DAX to Germany, Eurostoxx 50 to Europe, Hang Seng to Hong Kong, Nikkei 225 to Japan, Shanghai to China, and Kospi to South Korea. Every bar begins at exactly 100%. From this point forward, it's not about where these markets started. It's about what happened next. The first few years look relatively calm, but underneath the surface, the global economy is changing. China experiences a major stock market sell-off in 2015, raising concerns about economic growth and sending shockwaves through global markets. Oil prices collapse, emerging markets come under pressure, and investors begin questioning whether the long period of global growth can continue. But despite these concerns, several markets continue moving higher. Then comes 2016, and another major surprise. The United Kingdom votes to leave the European Union. Brexit creates uncertainty across European markets, and the FTSE 100 and other European indices react sharply. Yet the market's reaction isn't as straightforward as many expected. Some markets recover surprisingly quickly, reminding investors of an important lesson. What looks like a disaster in the short term doesn't always determine the long-term winner. And while all of this is happening, the United States begins building something much bigger. The American stock market continues climbing, supported by strong technology companies and a growing dominance of the digital economy. The S&P 500 and Dow Jones move steadily higher, but the real star is beginning to emerge. In the Nasdaq 100, technology companies are becoming increasingly important to the global economy, and investors are starting to reward them heavily. By 2018, however, another problem appears. The United States and China become locked in a major trade dispute. Tariffs increase, businesses face uncertainty, and global markets become more volatile. China is hit particularly hard, while investors around the world worry that a prolonged trade war could damage global economic growth. The race becomes much more unpredictable. And then, just as the markets begin moving forward again, the biggest shock of the entire race arrives. COVID-19. In early 2020, the world effectively presses the pause button. Businesses close, international travel collapses, unemployment rises, and governments introduce lockdowns on a scale never seen before. Stock markets around the world plunge. The bars that had spent years climbing suddenly fall dramatically. For a moment, it looks like the entire race has been reset. But what happens next is one of the most extraordinary recoveries in modern market history. Governments and central banks respond with massive economic support. Interest rates are pushed down. Liquidity floods the financial system, and investors begin looking beyond the immediate crisis. Technology companies become even more important as millions of people shift toward remote work, online shopping, cloud computing, and digital services. And the Nasdaq 100 takes off. The recovery is incredibly fast. Markets that had collapsed only months earlier begin climbing again. The S&P 500 follows. The Dow Jones recovers. India also begins a powerful market expansion, with the Nifty 50 and Sensex moving significantly higher as investors look toward India's long-term growth. But the race is changing. The pandemic has accelerated the importance of technology, and the companies benefiting from this transformation begin dominating investor attention. Then, in 2022, another shock hits. Inflation surges around the world. After years of extremely low interest rates, central banks suddenly have a very different problem. To control inflation, interest rates rise aggressively. Higher rates make borrowing more expensive and reduce the value investors place on future profits. The result? Another major market correction. Technology stocks are hit particularly hard, and the Nasdaq 100 loses some of its enormous pandemic-era gains. But this isn't just an American problem. Markets across Europe and Asia also struggle. The global economy is dealing with inflation, higher borrowing costs, energy shocks, and the continuing consequences of the Russia-Ukraine war. For investors watching this race, it becomes a reminder that a market doesn't move in a straight line. A market can dominate for years and still experience a brutal fall. But then something remarkable happens again. As inflation begins to ease and investors start looking ahead, technology returns to the spotlight. Artificial intelligence becomes one of the biggest investment themes in the world. Companies involved in AI infrastructure, semiconductors, cloud computing, and advanced technology begin attracting enormous amounts of capital. And once again, the Nasdaq 100 begins accelerating. The American market's advantage becomes increasingly visible. The S&P 500 also benefits from the strength of large technology companies, while the Dow Jones follows a more traditional path. Meanwhile, India continues its own remarkable climb, supported by strong domestic participation, economic growth, and rising investor confidence. Japan, after decades of slower performance, finds new momentum with corporate reforms and changing investor sentiment, helping the Nikkei 225 climb strongly. But China's market tells a very different story. Despite being one of the world's largest economies, Chinese stocks face a series of challenges, including the property sector crisis, economic concerns, regulatory changes, and weaker investor confidence. The Shanghai market struggles to match the extraordinary gains being seen in some other parts of the world, and Hong Kong faces its own difficulties. The Hang Seng, once considered one of Asia's most important stock market benchmarks, struggles through a difficult period as China's economic slowdown, property concerns, and geopolitical tensions weigh on investor sentiment. South Korea's Kospi also experiences a very different journey. Its performance is heavily influenced by the global semiconductor cycle, meaning that when demand for chips and technology rises, the market can accelerate. But when the sector struggles, the pressure can be significant. And now, as the bars approach August 2026, the race looks completely different from where it began. Remember, every market started at exactly 100%. But after more than 11 years of market crashes, recoveries, wars, inflation, technological revolutions, political shocks, and economic transformations, the gap between the leaders and the laggards has become enormous. Some markets have multiplied the original investment several times over. Others have grown much more slowly, and some have spent long periods simply trying to recover lost ground. So if you had invested that $10,000 back in January 2015, the most important question wouldn't have been whether you could predict the next crash. It would have been whether you could choose the right market and then stay invested through everything that happened afterward. Because this chart reveals something fascinating. The best performing market wasn't simply the market that avoided every crisis. In fact, some of the biggest winners experienced enormous crashes along the way. The difference was what happened after those crashes. And that may be the most important lesson from this entire race. Markets don't move because of one event. They move through thousands of decisions made by investors reacting to economic growth, interest rates, inflation, technology, corporate earnings, politics, and expectations about the future. If you enjoyed seeing global markets compete like this, don't forget to like this video and subscribe to Decoding the Numbers.